Moving on to accounting equation. So in last class we discussed a bit about income statement, balance sheet and cash flow. And in that we discussed that balance sheet is a financial statement that tells you about the financial position of the company. That what is the liquidity, what is the solvency. Two key analysis performed with respect to balance sheet are liquidity and solvency. How is balance sheet prepared? So balance sheet is based on a basic business equation, that is a basic accounting equation, that is assets are equal to liabilities and equity. For you to buy any asset or for you to invest anything, you need capital, and that capital can either come from equity or it can come from liabilities. So that means assets are equal to liabilities and equity. Within this equity you can have a contributed capital, that is contributed by the owner or the investor at the start, and then there is another component, that is ending retained earnings. Ending retained earnings are kind of reserve that you have retained from the past income. So if you generate income and if you do not pay it out as dividend to the shareholders and you retain something with you, that becomes your retained earnings. So ending balance of retained earnings is a reserve that you have accumulated over the past through your profits by retaining your profits with the company. So that means this owner's equity can be replaced by contributed capital and ending retained earnings, because owner's equity is contributed capital and ending retained earnings. So assets become liabilities plus contributed capital plus ending retained earnings. Now this, how do we arrive at this ending retained earnings? So there is a beginning balance of retained earnings, that is at the start of the year. So at the start of the year you will have some retained earnings reserve with you. Then during the year you will make income. When you generate income or make profit, that would add to these retained earnings. So you will add net income. Then from this net income you will pay out some dividends to shareholders. So you subtract dividends, and the remaining amount is here is the retained earnings that you have retained with you. So this net income minus dividend is retained earnings for the year, and when you add it to starting or beginning retained earnings, that becomes your ending retained earnings or ending balance of retained earnings. So that means this ending retained earnings can again be broken down into three different components, that is beginning retained earnings plus net income minus dividend. Now this net income can further be broken down into income minus expenses or revenue minus expenses simply. So if you further break this net income into a revenue minus expenses, you will arrive at the definition of assets or equation of assets, that is liabilities plus contributed capital plus beginning retained earnings plus revenue minus expenses minus dividends. So this is the basic equation for coming up with assets. So for any asset to increase, one of these components need to increase. So if for balance sheet to remain be balanced. Now when you are analyzing the accounts as we go further, you will need to analyze or you will need to find out that what is actually leading to increase in assets. Whether is it a loan that is leading to increase in asset, whether is it an additional capital or revenue or dividend, or what is leading to increase or decrease in asset. But for assets to increase, one of these components need to increase, or for asset to decrease, one of these components need to change. So remember this basic definition. Now the idea is that this should tell you that balance sheet cannot be analyzed in isolation. For you to analyze balance sheet or for you to make most out of balance sheet, you need to look at the income statement as well. Why? Because balance sheet is reporting assets, and assets are dependent on revenues, expenses and dividends. That means for you to analyze balance sheet, you should first look at the income statement that includes revenues and expenses, and then you should look at the appropriation of income that includes dividend. So all the accounting statements are linked. You cannot just analyze any accounting statement or any financial statement in isolation, and these links should be obvious, and these links is something that you should remember. So here is a very basic example. Determine amount of equity as at 31st December 2005. What is equity? assets are equal to liabilities plus equity. So equity is asset minus liabilities. So what is the equity in 2005 here? 2.8 million. That is assets minus liabilities. Now if you look at the, if this is the snapshot of balance sheet, let's say that you have and you are trying to find out what has been the change. So what is the change in asset? The change in asset is 4 million minus 3.6 million. That is approximately 0.4 million. What is change in equity? Change in equity would be 2.4 million minus 2.8 million. So your assets have increased. Sorry, this is not asset. This is asset. So your assets have increased from 3.6 to 4. That is 0.4 million, and your equity has increased from 2.4 to 2.8. That is again 0.4 million. So in this case, and if you do it in decimal terms, it is coming up to be 0.4 and 0.4. But if you do it in up to 2 or 3 decimal places, it will be different. So the key idea is that whenever you are analyzing the overall total strength of the company, first thing that you look at is the change in asset. That how much is the total asset changing? That would tell you that how much is the total worth of the company, or how much is the total strength of the company changing. Then next step is that you should find out why is that change coming in. Is it coming in from equity, or is it coming in from liabilities? So if it is coming in from liabilities, you would know that the company is borrowing money and the risk associated with the company is increasing. And if it is a result of increase in retained earnings, that is positive. That means the company is making money, and as the company is making money, it is investing more into assets. So not just looking at the increase or decrease in asset is enough. You should also be able to analyze that where is this change coming in. So broadly, you should be able to analyze whether is it a result of equity or is it a result of liabilities. And once you know that, then you can deep dive into it and you can find out what is actually changing in equity or what is actually changing in liabilities. So moving on to another example. An analyst has collected the following information regarding a company in advance of its year-end earnings announcement. The analyst's estimate of ending retained earnings. So these are the results from the year, and you have to calculate ending retained earnings. What would be the ending retained earnings from this? Sorry, 2100. That is your beginning retained earnings, 2000, plus your net income for the year, and minus dividends. That is your distribution to owners. That is 2100. So that means in your retained earnings within this 2100, 2000 is coming in from income from that year, and 150 has been brought out from previous year. So moving on a bit further, an analyst compile the, so you know that equity is you know that retained earnings are changing, and in retained earnings now you know that what has actually changed or what has brought that change in retained earnings. Now moving on, if you want to deep dive further, an analyst has compiled the following information regarding RDZ. There have been no distribution to owners. The analyst estimate of total assets at year end should be closest to. What should be the estimate of assets at year end? So what is assets? Assets are liabilities plus equity. So assets at end would be liabilities at end plus equity at end. So liabilities at year end are 1000 plus what is equity? Equity is contributed capital, that is again 1000, plus beginning retained earnings, that is 500, plus net income, that is revenue minus expenses. And if you solve it, you should be able to arrive at the answer, whatever it is. So this is about the basic equation of balance sheet or the basic equation of accounts, or how our accounts link. So any change in asset can come from, or any change in any of these items can come from income statement or can come from balance sheet. So you should be able to find out where is that actual change coming in from.